Welcome, everyone, to this episode of the Expansive CEO podcast. I am your host, Hannah Chapman, and it is Thursday, July 17th. It's 1:13 p.m. Pacific time right now. And you know what that means? It means it's another Investment Friday episode. I am joined again by my good friend, Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. And today we're going to talk about the Fed. We're going to talk about the Federal Reserve, the Federal Open Market Committee, all of the different ways that this group of humans influence and react to our economy and the things that are happening, and how they control interest rates and all of these important topics, especially given what some of the things that have been in the news the last couple of days. So I'll start there. And Brad, how are you doing?
I'm doing great.
Good.
I'm doing great. It's beautiful outside. The markets are up. What's not to like?
Exactly. It's so I'm in Phoenix, and the high I think was like 92 in
Oh,
July, excuse me.
wow.
So yeah, it's like not bad. It's breezy.
Do you guys
High
have
cloud.
like monsoons coming in?
No, not necessarily. I mean, we've got some high clouds, chance for some rain, but not, we didn't really get any, but it is pleasant,
Wow, that's really good.
right? So soaking that in. Um, yeah, so let's like take in that energy. It's nice.
Yeah, it's nice. Not bad.
Before we talk
Um,
about the crazy.
okay. So the Federal Reserve front and center again. Whether it's, President Trump threatening to fire or joking about firing Jerome Powell, the chairman of the Federal Reserve. Um, or it's the Federal Reserve. What are they going to do with interest rates?
Right.
Right? How is that going to? And that I think has been the major factor in how people are reacting in the investment markets, which is one of the reasons that the the uh, the markets have come up is because this week we got both consumer price inflation and we also received producer price inflation, which for those who don't know, consumer price inflation are for those obviously consumers, right? It's the end buyer, right? The consumer that purchases a good or service. How did that price change over the last month or the last year? Producer price um, is the intermediate goods. So if I'm a manufacturer, I buy goods from another company that I use to make whatever I'm making. Okay. That's an intermediate good, if you will. So then what I do is I take that good in, make whatever I'm making, and then I sell it to some distribution source, right? A retail store, sell it online, whatever. But the intermediate good is called the producer price inflation, and it measures kind of in the supply chain where inflation and both of them came in pretty tame and pretty moderate. So there's a lot of speculation. Well, the Federal Reserve should definitely be able to lower interest rates now because even with the 10% universal tariff being applied, hasn't really bumped inflation all that much. However, sectoral tariffs, which again we described a couple of weeks ago, are they're tariffs that are being applied to a certain product or a certain industry. For example, copper.
Right.
Copper is very important as a commodity in in the global economy. It's in every car, it's in every computer, it's in every electronic um, gadget, which now includes your dishwasher, your refrigerator, your um, light sockets. I mean, it's in everything. So it's kind of a bellwether for how the economy is really doing. So increasing that price, I think President Trump, I think it was a week ago or a couple of weeks ago, he applied a sectoral tariff on copper, and then obviously we already have some on aluminum and steel and the like. So he's also threatened more on pharmaceuticals, and a couple of other product types.
Mm,
Those are not in there yet. They're coming, but they're not in there yet. So I think that, and this is one of the things I've been trying to really reemphasize with our clients and with our financial advisors is as long as inflation, overall inflation is low, the US economy can handle the tariffs. Okay.
mhm.
As long as the tariffs aren't too extreme. Now, again, we have August 1st coming up. That's the deadline or the new deadline for the country by country reciprocal tariffs, which are those that are supposed to um, punish those that have a huge surplus with us, or i.e., encourage consumers to go elsewhere, and businesses to reshore their supply chains either in the US or to a friendly country that has more of a surplus with us or more of a deficit with us. So we'll see. But as it stands right now, the Federal Reserve has and their actions have come to the front and center of the narrative because of their ability to set monetary policy.
Right. And to kind of kick off that discussion a little more specifically as well, I wanted to talk about the Fed today, and we mentioned this last week because it's in the headlines. We hear about Jay Powell, Jerome Powell, a lot because he is the Fed chairman right now. But that he is not the only person. He's not setting economic policy all by himself, sitting in an office, making decisions, and then just, coming out and telling everyone what he's doing. He's part of a pretty wide network. And there's more than one Federal Reserve, right? Like there are different Federal Reserves around the country that have their own committees. And so I wanted to talk a little bit about the structure. And then I also wanted to address that point that, Trump has said many times, even in his first term. So he appointed Jerome Powell to the Fed chairmanship in 2017. And Jerome Powell was the person that was there at the helm during COVID, right? And part of what Trump was trying to pressure him to do in his first term was to take interest rates negative. So interest rates were very, very low for an extended period of time. And it was a really interesting period where, he was really pressuring, trying to apply political pressure to get interest rates into the negatives, which Japan had negative interest rates for a while. Was there someone in the European Union?
European Central Bank.
The European Central Bank was negative for a while. And that's a very different economic policy, right? It's not, I don't know, it's not necessarily there. We could go into that some other time, but it's not necessarily a good thing.
No, it's actually a really bad thing.
Right. That means
And
you
it doesn't
literally,
work for anybody who wants to know. Um,
Brad has
they
strong
did,
opinions.
well, I mean, the US came out of it. We had higher interest rates than them. We came out of the economic doldrums much, much more quickly than anybody that actually went to negative.
Yeah.
There's a certain, and I'm just going to take a very slight detour. There are types of tools that we can use to generate economic growth. And when you have interest rates that are very, very, very low, it's indicative of the fact you do not have a lot of economic growth in the economy. And one tool we can use is monetary policy, which the Federal Reserve controls. Okay, and we're going to talk more about that today. The other one, fiscal policy, which is what Congress and the president control. It's the spending, it's the infrastructure projects that you can do. That is a very, very powerful tool. And unfortunately, really since the 1980s, um, has been underwhelming in terms of its impact on the US economy because we haven't really needed it, with the exception of 2007, 2008, 2009,
Mhm.
where effectively we went through a balance sheet recession, and the government had to spend because no one else could.
Right.
So,
Yeah. So going back, or going forward in time a little bit, again, Trump is the one who appointed Jerome
mhm.
Powell, just in case anyone was confused about that. He appointed him in 2017, and he was reappointed by Joe Biden in 2021 or 2022, something like that. And he's still the Fed chairman right now. This is meant to be an apolitical position. It is not meant to be political in any way, shape, or form. It's not meant to be partisan in any way, shape, or form. It is meant to be very separate from the person who appointed this position. It has been that way for a very, very long time for a very important reason, because we do not want our economic policy to be set in that same way. We don't want it to be influenced by the whims of the president or Congress, or we don't want political pressure to get in the way of making economic decisions when it comes to interest rate policy.
Yeah, in fact, it's by law that the governors cannot be dominated by one party or the other.
Oh,
So we're going to
interesting.
talk a little about that, like what that why is that?
Yeah, yeah. I mean, it's just there's so much here that I think we just don't learn about it a lot, right? We just hear about whoever the Fed chairman is, and their opinions, and then when they come out and give a press conference and the stock market either tanks or rises, right? Then we hear about it and people get upset or elated, whatever. Um, and we don't understand the workings of or how they're making those decisions. So I would love for you to talk about. So first, let's talk about Jerome Powell real quick. When did
Okay.
his term start, and how long does he have in that position? And then what does it look like for, a new person to potentially come into that position?
Okay. I'm going to take a step back because there's two terms he's serving right now. Jerome Powell, as a Federal Reserve governor, is serving a 14-year term. Okay. The Federal Reserve has 12 governors that sit on their board of governors. Okay. They each represent the 12 Federal Reserve districts, which are um, they're just geographical areas that each of those areas have a Federal Reserve Bank in them. So, for example, sometimes you'll hear the New York Fed. Well, that's the Federal Reserve Bank of New York. Okay. You'll hear the Federal Reserve Bank of St. Louis, right? Well, they cover that area. And what those Federal Reserve banks they're supposed to cover that area for bank stability, for economic research, for monitoring economic activities. They have all of that bandwidth. They act as banks for the very large money center banks like Citigroup. If you ever wanted to know who Bank of America's bank is, it's the Federal Reserve. Okay. Who does Wells Fargo bank with? The Federal Reserve. Okay.
Yeah.
So the Federal Reserve system, banking system, is what the large banks bank with. And then it tiers down from there. The very, very small banks actually have another bank. So they bank with the large banks. Like, for example, if it's XYZ Bank that's in your hometown, they bank with a larger bank, like Bank of America. It's called correspondent banking. And then B of A, Bank of America, then um, banks with the Fed. Okay. So there's 12 governors. Okay. So that's one term. Each of those governors, as they're appointed by the president and confirmed by the Senate, serve a 14-year term. All right. By law, those governors have to be pretty much equal weight between Democrats and Republicans. Okay. So that's an interesting. So why are we doing that? We're trying to make it politically insensitive to what's going on today. Because if you run economies by politics, it never ends well. In fact, it ends horrifically if you use history as a guide. So they made it very, very stringent that it's an apolitical process, which is why, I mean, presidents and President Trump is definitely not the only president to do this. Almost all presidents over time have made um, some of their economic hopes public,
Right.
right? And so there's a reason for that. I mean, presidents um, have to please the populace, the citizenry, right, that elected them. Well, the Federal Reserve doesn't. They're only beholden to the economy and to the people themselves based on the two mandates they have, which are price stability. So if we say that another way, it's we try to keep inflation very low, not negative, but just very low in a positive area, which is why we have a target. They have a target range of 2% per year is the average inflation rate that they want to accomplish.
Hmm.
Doing that while keeping full employment. So you have two mandates, and oftentimes those mandates are at odds with each other sometimes, but they want to keep full employment. They want to keep price stability. That by law is their job. Anything else with the economy, they may have a very informed opinion about, but that's not what they're responsible for. So oftentimes when you see them being put in front of Congress and the representatives or the senators are asking them about some kind of politically inspired questions, they may have a personal opinion about it, but they're not going to necessarily say, as a Fed governor or the chair of the Fed, this is what we think, because they don't. They only have those two ends in mind. Um, so from those Fed governors, we have a Federal Open Market Committee. Now, what's the
Okay.
Federal Open Market Committee?
Right. So these 12 governors form the Federal Open Market Committee, or FOMC. You may have heard that acronym before.
Excellent. Excellent. Okay. Um, that's correct. So the Federal Open Market Committee is basically seven governors, okay? The New York Fed president, so the president of the New York Fed, and then four rotating other presidents of the Fed. So for example, you might have um, the governors, so the seven governors, and then you might have, or you would have the New York Fed, and then you might have St. Louis, Atlanta, or San Francisco, and one other, okay, Minnesota. All right, so you might have a smattering of others. Those individuals together are what we call the Federal Open Market Committee. That is the committee responsible for setting interest rate policy for the U.S. economy. And as it turns out, much of the world, because a lot of countries either peg to our dollar, they try to keep a very tight, ratio to the US dollar, or they have a lot of companies or governments in that area that issue debt in US dollar terms. So instead of India doing it in the rupee, they would do it in US dollars. Okay,
Hmm.
there's a lot of reasons for doing that, but when that happens, US policy, US Federal Reserve policy does influence the world more than just the US domestic economy. Um, Now, like I said, governors are appointed for 14-year terms, okay? And they cannot be let go except for just cause. So they're not able to be fired by the President of the United States or Congress. They can get impeached, but that's for cause, okay?
Mm.
Um, there's two leadership positions, okay? One is the Reserve Chair, which is Jerome Powell, and he is serving right now a 4-year term as the chairman. Now, that is renewable every 4 years, and he has to have Senate approval every 4 years. Same with the vice chair. Okay. The vice chair is just his vice president, basically. It's his assistant, basically. Not really, but pretty close. I
Right.
mean, that person takes over if Jerome Powell gets hit by a bus.
Right.
Um, so again, those individuals historically have been very steeped in economic policy, economic empirical data analysis, and really doing a good job. And they're looking long term for the economy. They're not looking right like at the next 2 weeks. They're
Right.
looking much longer term. And so a lot of the policies they do, because the economy is so big and so diverse, it takes a long time for their policies to infiltrate all areas of the economy. Um, so it just, so being politically sensitive would be terrible because you'd keep switching policies back and forth in an extreme way, and eventually the US consumer would stop being sensitive to it, and the economy would not be in a good space.
So we have when was Jerome Powell first appointed as a Fed governor? So what how long is that 14-year term?
It ends in 2028.
Okay,
So I
so
think,
he was appointed then in 2014.
yeah,
He has until
around there, yeah.
2028. Um, do they ever get appointed again? Or is it usually like a 14-year term and you're done?
I think it's usually a 14-year term and done.
Okay. And so he has until 2028 as a Fed governor, cannot be removed as a Fed governor except for by cause if he were to be impeached. And then as the Fed chairman, so the chairman of that committee that he has been appointed to, he served one 4-year term starting in 2017 and then another 4-year term started where that was started under Biden. Is that correct?
Okay, well, let me correct you a little bit. I just kind of looked it up.
Okay, good.
So he was appointed in 2012 as a governor because someone stepped down early.
Oh,
So he was appointed to fill the remaining point in that tenure, or in that term, if you will. So he was appointed in 2012. He got reappointed in 2014 to the full 14-year term.
okay.
Okay. He was appointed chair in 2018, which again, he was then reappointed as chair in 2022 by
Okay.
President Biden. So the 2018 was President Trump, that initially nominated him as chair, and then he was reappointed as chair by President Biden in 2022, which means his term as chairman is coming up in May of 2026.
So again, just to clarify the news that we heard this week, unless he is impeached for cause, unless they have, and Congress has cause to impeach him, they cannot remove him. He cannot be fired. He cannot be removed from that position as chairman prior to the ending of his term in May of 2026. And then even at that point, he still has the rest of his term as a governor through 2028.
Yep. But then that's it.
And then that's it. Okay.
Yep. You can only serve one full term as a governor. Once you've done that, you're done.
Okay. Then he goes and gets to go be an economic philosopher again, right? Or whatever, work at another bank or
Or probably retire. I mean, this has been a lot for him.
hopefully.
I mean, these jobs are not any jobs that many I mean, I think some economists would want them, but they're rough. They're very,
Yeah.
very difficult jobs. They're very stressful. I mean, everybody blames you when things are going bad, and you never get accolades when things are going well.
Oh,
Uh,
that's such a good point. That is such a good point.
yeah. So it's like it's a thankless job a little bit. So if I were him, I would probably want to retire and just, go to the Caribbean for a while. But you never know. You have to see what these guys, what he decides to do with his life.
So with that, like with the structure of that, again, he's usually the mouthpiece. Right now, Jerome Powell is usually the mouthpiece that, when they come together and make a decision, again, we said that he doesn't make decisions on his own. He doesn't
No.
say, I feel like, lowering interest rates or raising interest rates, and so I'm going to do that. It happens in committee. So who are all the people that inform that decision when they meet on a quarterly basis? And
So inform the decision or help him make the decision.
both. Yeah, like what are the
Okay.
tiers?
Okay. So the Federal Reserve banks, that system of banks, has an enormous staff of research analysts and economists and traders and um, data collection and data analysis groups. All of those individuals are responsible for giving the governors or the members of the Federal Open Market Committee all of the relevant and timely data that they're going to need to make decisions based on this or based on these events. Okay. So there's lots of them. I mean, it's a big system. It's a big bank. So although all the employees help surface, analyze, clean, make sense of the data. Okay. Um, the people that are on the Federal Open Market Committee, we kind of went through, they're the 5 regional presidents that rotate. There's the president of the New York Fed, which is always a member of it, and then 7 governors. Um, those individuals each have a vote as to whether to raise interest rates, keep interest rates the same, or to lower interest rates, and then by how much. Historically, and by historically, I mean under Jerome Powell, um, they've generally made um, most decisions unanimously,
Wow.
with maybe one, pretty rarely two dissenting opinions. Okay. Um, I mean, it's not totally unusual to have a dissenter, so it's not always the case, but um, periodically you have two dissenters, and that's kind of unusual. But normally that means just under Jerome Powell, he's tried to build consensus before doing an action, making a change in interest rate policy. Um, so Jerome Powell has one vote on that committee, right? Out of 13, 14, because
Hmm.
there's 14 members in total. He has one vote. So he does have some influence, right? If he believes that interest rates need to be lower, he can make that case. And if he makes it persuasively, great. We can lower interest rates. But there are other people. I mean, all these people are professional economists. So they all have very strong opinions about what they think should occur. And which is why sometimes between those meetings where they change interest rate policy, you have a lot of them giving speeches. And in those speeches, they might kind of give an insight into how they personally think, but as a member of the board, going forward, we'll see. Um, so it's just an interesting. He might try to be persuasive, but it's pretty difficult when you know you've got these men and women are at the top of their game in terms of economics, and
Hmm.
I mean, if they just don't want to go with it, they won't.
Well, and so that then um, also adds to the apoliticalness of this
Mhm.
process, right? Again, it's not one person making a decision. He has 1/14th of the decision as the
Right.
chairman.
Yep.
And so and that's actually like truly, it feels like for that position and for what they are trying to accomplish, to be able to get unanimity that often seems really like important and impressive to me. There's something about that to me that's like, oh, like coming to consensus. Also, it slows things down,
Hmm.
right? So, because it's not like, all right, we got a simple majority, like done, we're going. It's like, hey, let's wait, let's chew on this, let's contemplate this, let's talk about this until we can come to a decision that everyone is, for the most part, is on board with. And that takes a lot more work than getting to, 8 out of 14. So that's really interesting to me. But it also then goes to show that, okay, in May of 2026, when his, time as chairman is up, which I assume it would be, because then if he had another 4-year term, like he can't serve another 4-year term, right? As the Fed chair, could he?
He can. He can be reappointed. If, for example, the president decides, if for some reason Donald Trump decides Jerome Powell did a fantastic job, which at this point is unlikely, but he could then reappoint because those are the leadership positions, the chair and the vice chair are renewable as many times as within that 14-year term. Um, you can be reappointed. So
So
I
he
think three.
so he
Yeah.
could be, yeah, he could be reappointed one more time and serve out that,
Yep.
but then he would be done.
Correct. He would be off the board and he would not be in leadership, obviously. So he could be reappointed, but again, he has to be um revetted by the Senate and reconfirmed by the Senate. So it's in this scenario, I don't think it's likely at all. I think Jerome Powell, I think he's actually probably looking forward to just being the governor again and not the lashing boy for President Trump. But you know, I think for the most part he's done a pretty good job. I think he was a little slow on raising interest rates as fast as we had pumped liquidity in the economy. I
Mm,
wish he would have been a little faster and a little more proactive in that. But I'll give him the benefit of the doubt. We were going through a massive change. We just shut down the world and restarted it again.
right,
And so there's a lot of knock-on effects that really no one would have known about, So yeah, I'm not going to second guess him, even though I can armchair quarterback, years after the event.
right,
But as you're going through it during that time, I mean, I think the U.S. government, both fiscally and monetarily, did a phenomenal job in mitigating the what could have been a depression in 2020 from the COVID crisis
right,
pandemic, because it could have sent us into a depression, which if the government had not stepped up for fiscal stimulus and pumped in monetary stimulus, um, I think I said I think I said this before, that we were within hours of having a full-blown credit crisis, which for those watching and hearing, if you didn't see our clip last time, a credit crisis is essentially where the credit markets stop functioning. No one trades with each other and no one so why that's a big deal is, let's say you have investments and you always assume those investments can be sold and converted into cash for you to do whatever with, whether it's to save, pay down debt, or to spend. Um, well, that's the same for banks, insurance companies, asset management companies, companies around the world that are doing business. They have their cash saved in short-term instruments like money market funds, but if those are no longer trading, how do you convert that into cash?
right.
You don't. And so the economy comes to a screeching halt and your economy starts to contract pretty rapidly. Um, so we were within hours of that happening in 2020. And the Federal Reserve stepped up big time and kind of saved the day, kept markets functioning, kept it going real well. And all of a sudden you can see things started taking off because you had now the combination of monetary and fiscal stimulus, and we were off to the races. Now, we went too much to the races a
Right.
little bit. So, and that's, we've been dealing with that for the past 3 years. So, but looks like inflation, like I said earlier in this podcast, inflation looks like it's pretty tame. Right now, it says it's coping with the tariffs that have been applied. So as long as those, country reciprocal tariffs don't get too high, the U.S. economy should hum along a little bit.
And talking about interest rates, I mean, we've seen some talk lately and forecasting, right? So this is Wall Street forecasting, right? When they're doing futures and predictions about what's going to happen with interest rate policy, we're kind of expecting that rates will go down this year, that we'll start to see some interest
We'll,
rate coming down.
yeah, we'll start to see some interest rates decline.
And so when we when is the next meeting? Isn't it in July? Is it coming up really soon?
It is, hold on. I've got my calendar right here. It is in July, July 29th and 30th.
Okay, so that is not next week, but the week after.
Yep.
We'll get to see this, and then when we talk about it in a couple of weeks, we'll hear from Jerome Powell. He will tell everyone what the decision was. Um, but again, emphasizing that it's that entire group of 14 that are making that decision together. And if Jerome Powell were to be replaced in May of 2026, even if that person was, let's say it's a politically balanced, you know, committee, even if that person leans Republican, there's still one vote out of 14. It's not like we can just drop in. I guess that's kind of the interesting part. Or maybe they would try like drop in a new governor who has,
Well, even if they did, like you said, it's one of 14.
yeah,
I mean, and I gov economists are an interesting lot because we're political a little bit in our participation because we have strong feelings about how the economy should run, like the optimal way of running it, right? You have some that are more left leaning, if you will, kind of democratic socialism is kind of what they, in their mindset's the best way to do it. Everything's fiscal policy, um, kind of Keynesian, if we want to use that term for, I hope I didn't give anybody shock from their economics 101, you know, any PTSD coming up there. Um, and then you have on the kind of the right leaning ones that are more, free markets, laissez-faire, all of those. And you have them all in between. Those are two ends of the spectrum. But um, economists are not people that are just going to be politically driven. They are social scientists in the sense that they study the data, they study history, they know, you know, they have the best they try to take the probabilities of their actions and try to have the best outcome. And it's a very difficult task when you have the largest economy in the world, 350 million people in it, making all of these decisions on a daily basis on what they're going to do with their money or not do with their money. And that all impacts what their decision is. All of those data. For example, if I go out today and I buy a soda, that transaction is analyzed eventually for consumption by the Federal Open Market Committee.
that's true.
Okay. So every transaction is somehow fed into that system. And the way it does through mine is I'm going to use my card. I'm going to use my debit card. Boom. $2 for a soda or a buck 50 for a soda, $3 for a soda, depending on where you live. Um, and then so Wells Fargo, B of A, Citigroup, JP Morgan Chase, they all know what we're spending, and all of that data gets filtered up so that they can make the best decision possible. But is it the most politically expedient decision? Not likely. I mean, all presidents want to see no interest, very low interest rates, high returns on equity, high growth,
Right.
no inflation, no unemployment. It's an unrealistic world at that point.
Right. And there's, again, like you said, the two mandates that they have to have price stability, which is, not let inflation get out of control, and full employment, which is making sure that, people who are looking for full-time employment can find it, right? And how do we massage economic policy and monetary policy in order to make those things happen? Um, so one thing we didn't get to talk about, which could be certainly a future episode, is how the Fed does monetary policy. Like what does that mean? Because that's a whole topic in and of itself, right? And the example that came up, just as a little side note, when you said, the Fed gets blamed when things feel like everything's, going to hell in a handbasket. But they don't get the credit when things are going really well. And one example of that was the quantitative easing
Yeah.
in 2008, 2009, 2010. The way that the quantitative easing that they put into the economy at that point actually made money for the government.
Oh, lots.
Right? Like they were so net positive on that trade. It's what helped get banks and insurance companies like back online and back on track, and it made money. And it's like that was a master class in how do we use monetary policy in a very win-win way. And I don't think it really gets talked about nearly enough. Or the Fed
Yeah.
doesn't get credit for it.
Yeah. I mean, the Federal Reserve, I'm just looking it up because I think it's hilarious. So in 2010 to 2017, um, the Fed earned about $90 billion. dollars.
Wow.
2020, it was just under 90. 2021 was 107. 2022 was 76. And then in 23, 24, it's been shrinking. It's been losing money because of the shrinking balance sheet, right? So that comes off there. So I think it's interesting.
Brad's just staring at a screen because he loves
Yeah,
charts.
sorry, I'm just looking this up again because it's an interesting dynamic because the Fed made so much money in certain years and now and they're really that's not what they're designed to do. It's just, through quantitative easing, through quantitative tightening, that's just what has happened. So it's just interesting to me.
Yeah,
It's
no, it is super
fascinating.
interesting. And I think if anyone's interested, we'll put it that way. If people have questions, if you want to learn more about the Fed or the inner workings of the banking system, where your money actually goes, what all that means, let us know. Like, we would love to answer your questions. We'd love to address those things specifically. And for now, we're going to, just wait. We're on a pause at the moment because Federal Open Market Committee wise, because they're not going to meet until the 29th or 30th. But then at that point, we'll get some interesting feedback and we'll see, right? I mean, futures markets make predictions on, all of this, but if they keep interest rates steady, which is what they've done for a while, how many meetings have they kept them steady?
Uh, Free, I think.
Okay. Yeah. So interest rates have stayed, they haven't gone up or down. Um, so if they start to ease interest rates, if they bring them down a little bit, the market's going to react. And
Yeah.
we've
So
already, oh, go ahead.
just to give you an idea, 97.5% probability that nothing happens in July.
Okay.
Okay, so interest rates stay the same in July. Um, in September, it's about 54% think we're going to get one interest rate cut starting in September.
Okay.
So that's when things start to look decent, which is what the equity prices are pricing in.
Right. Because we talked about that last time that, we were talking about. bad news is good news. And if we lower interest rates, that's what the market was projecting, that we'll lower interest rates and things will get better. Um, and so if we don't, this is the funny part. And so again, we'll see what happens is that if, say, they do cut interest rates in July, the market could take a dive because they're like, oh my God, they think it's worse than we think it is, right? Like there's such a massaging that goes on around what they do and then how they explain why they did what they did.
Yeah, I mean, I think we're going to see a lot more volatility surrounding just equity prices, um, because of the fact that the equity market has run up so much. And really, equity prices are reflective of increased profits, right? We talk a lot about the economy and all those types of things, but really what I'm looking at when I'm looking at the economy is, what are corporate profits going to do? Are they going to go up or down relative to the expectations today? And if I think they're going to go up, then more likely than not, we should invest. If I think corporate profits are going to go down, more likely than not, we should probably put a pause on it. And it's interesting just you know, to see that, to feel that. Um, and I think equity prices have gotten far ahead of themselves. So it's interesting. We have to kind of watch out for that a little bit. Um, um, Although I think over the next 5 years, it's going to be a non-event, and the equity prices are going to be much higher than they are today.
And that long-term view really is what governs more of our today decision making in this space. So
For
thank you,
sure.
Brad,
Thank
for
you.
being here as always. If you have any questions, you know where to find us. All of the links are in the show notes, or you can, just leave a comment on LinkedIn or Facebook or wherever you are. Um, and we'll see you next time. Thanks, Brad.
Sounds good.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.